What's going on, YouTube? And more importantly, what's going on with interest rates? As we know, interest rates are a key indicator of the direction of house prices. If interest rates go lower, house prices are likely to go up. And if interest rates rise, we're likely to continue seeing home prices come down. But what happens if they stay where they are at the moment? Well, that's what we're going to talk about in today's video. We're going to talk about where we've been right with interest rates, where I've been right with my predictions, where I've been wrong with my predictions, and what I see over the next couple of months with regards to the future of interest rates. At the moment, we're seeing more and more home buyers back out of deals. At the same time, we're seeing home builders saying that the U.S. housing market is in a housing recession, as housing sentiment is at its lowest level in the last couple of years. On top of that, we're seeing mortgage applications dry up. But why? Why are mortgage applications such a key driver of the housing market? So overall, mortgage applications fell by more than 2% to the lowest level since 2000. Home purchase applications continue to be held down by rapidly drying up demand, as high mortgage rates, challenging affordability, and a gloomier outlook of the economy kept buyers on the sidelines. So as we've seen interest rates go from the low 3% range to upwards of 6%, we saw affordability affected in many markets. At the same time, we're seeing year-over-year appreciation because housing prices at the beginning of the year were still rising. And that, on top of interest rates, has affected many potential home buyers out there, more or less putting them on the sidelines, not because they don't want to own a house, but because they can't afford the payments associated with a house, or they've been priced out of the price range in which they were looking, and therefore they have to sit and wait, or in some cases maybe accept a higher rate or still go into that higher price point and pay more per month, which many people are unwilling to do because they're worried about the future of the economy. And so a couple of weeks ago, I talked about interest rates in a video that I'll post here, giving my prediction of how the Fed raising the Fed funds rate would actually impact interest rates and how the lack of a meeting in August could affect rates negatively, which fortunately we didn't see. And we'll talk about that here more in just a minute. But what we've discussed in several videos is that if the Fed does what the market wants it to do or is expecting, then interest rates don't really move in a volatile fashion. They're more volatile when the Fed reacts differently from what the market is expecting. So over the last couple of months, the Fed has been pretty clear in their plan, if you will, with regards to inflation numbers. If inflation numbers come high, they're going to get aggressive. And we've seen that in the last two Fed funds meetings where they've raised the Fed funds rate by 1.5% between those two meetings. Super aggressive. And through that time, we didn't really see interest rates react in a negative way. In fact, we saw interest rates stay more or less in a range. But the one unknown out there were the numbers that were coming out in August for July's inflation reading. And the reason that was a potential issue is because, those numbers are reported in August and the Fed doesn't actually meet in August. The Fed only meets 8 times a year. And so if the inflation numbers were much higher than expected, the Fed didn't have a scheduled meeting on hand like they did the previous 2 months, where they could come in after those inflation readings and get aggressive on their Fed funds hike, maybe do a little bit more than the market was expecting and kind of get things back in line. But fortunately, we saw inflation numbers for the month of July actually come in, and they were better than expected. And initially, the market didn't really like it. I mean, it was in line with what they expected, but rates didn't move significantly lower. In fact, we saw the 10-year trickle up a little bit. And then over, a day or two, we actually saw interest rates and the 10-year pull back because the market saw it as a positive thing. And that's what I want to talk about here for just a minute. And this little blurb I'm about to read actually came from Mortgage News Daily. Some of the commentary they put out, which I thought was really good because it explains exactly what the market was expecting, what the Fed did, and how the market didn't really react the way we thought it would. Well, this is why. So why did rates make the counterintuitive move? The short version is that the market was already generally in agreement that inflation had topped out over the past few months. The next order of business was to react to strength or weakness in the economy. Lower inflation allows for more economic resilience, and it's economic resilience that will do more than anything to prevent rates from falling very quickly. Lower inflation also decreases the Fed's urgency to hike rates, and while that sounds like a good thing, it has been the austerity associated with those rate hikes that caused many investors to ramp up bets on economic weakness. So in short, what they're saying is that the market actually wants to see worse economic news than it does positive economic news. And by seeing lower inflation numbers, that's actually a positive thing for the market. But if we see positive things like inflation numbers go down, that might prevent interest rates from actually falling as quickly as many would like to see. So then shortly after, we saw this big decrease in the 10-year, you can see that interest rates retrace back to April numbers. And we've kind of been trading in this range from April until we are now, with the lows being, just under 5% and the highs being upwards of 6.25. Now, if you look at that graph, it kind of shows it at 5 and, just under 6, when in all reality, there were well-qualified buyers qualifying over that 6% range, 6.25. And, many well-qualified buyers, when rates went down, just over a week ago, we're getting somewhere in the 4.75% range. So we've seen them in that range between 4.75 and 6.25%. So we did see interest rates pull back. It looked really positive. The 10-year got down into the low 2.6 range. And then all of a sudden we got more positive news showing that payrolls had increased in July, more than expected. And the market took this as a negative thing, right? Because that gives the Fed more power to continue to raise the Fed funds rate because, their whole gauge on how aggressive they can get, a lot depends on the employment number. So as long as the employment number stays strong, the Fed sees it as an opportunity to continue to increase that Fed funds rate. And since then, we've seen interest rates again continue to trade in that range. They're lower than they were just a few weeks ago, but they're higher than they were just a week and a half ago. So at the beginning of the video, I mentioned we would talk about when I was right with interest rates and when I've been wrong. Well, over the last couple of months, I've mentioned that rates would probably trade in this range and that, 6% or so would probably be the high side. And I think, that would be the peak in rates this year. I still believe that unless we see, inflation numbers go up substantially, much more than the market was expecting. And we continue to see really strong employment numbers because that gives the Fed, again, the opportunity to continue raising the Fed funds rate, which in turn creates volatility in the market because that's not what the market's expecting them to necessarily do. They are expecting rate hikes because the Fed has mentioned it, but they're not expecting the Fed to do something out of turn, right? And so if we see super high inflation numbers or employment numbers remain really, really strong, different than what the market's expecting, that creates volatility. And volatility creates disparities in what the market was expecting versus what actually happened. And that in turn gives rates an opportunity to go up. And while I don't see it happening, it is definitely a possibility. But in all transparency, let's talk about where I was wrong. Well, back in the beginning of the year, January, February, I didn't think rates would go over 4%. Why? Because I thought that inflation was somewhat under control at that point. I didn't foresee the energy crisis, if you will, between Ukraine and Russia, the war there, putting pressure on energy. That energy translates into everything. It's a trickle-down effect. Gas is in everything, from transportation to export, import. It just really impacts everything. So that was kind of a black swan event between, again, the war in Ukraine and Russia. And that put additional strains on inflation, along with the bottlenecks that are still backed up in many markets. So I thought inflation was somewhat under control. I was wrong about that. And because of that, interest rates rose significantly from that point, right? And we saw them get as high as 6.25. But over the last couple of months, as the Fed has come out and laid out their plan and the market has more or less done what we expected it to do, interest rates have stayed pretty stable. And that's more or less what I expect them to do throughout the rest of the year. Now, the question I asked at the beginning of the video is, how does this predict the future of housing? Well, if interest rates continue to rise, that is going to continue to affect affordability. And as affordability gets affected, that's going to mean less buyers out there in the market. So if you're a believer that the economy is going to remain strong and the Fed can continue to hammer on the Fed funds rate and create volatility in the market, then that means you also believe that interest rates could go higher. And if interest rates go higher, I think that impacts housing prices, bringing them down. But if you're on the other side, which is where I am, where the economy isn't quite as strong as it looks, even though employment numbers are strong, there's companies out there laying people off. Now, I realize I go to the restaurant down the street, their hiring service sucks because they can't find good help. That doesn't necessarily mean that the employment market is super strong. Yes, there are jobs out there for those people that want to work, but at the end of the day, those restaurants are probably still going to suffer because there's less people out there spending money. And I think as the economy suffers, the Fed can't get nearly as aggressive on their hikes in the future. And with that, over time, inflation numbers should come down because supply bottlenecks are working themselves out. There's less people out there in the economy spending this discretionary money. There's less of it out there in the market, which should bring the prices of things back down. Now, back down where they were prior to COVID? Probably not, but lower, which again should bring these inflation numbers down. And along with that weakness in the economy, interest rates probably come back down some. Now, not back where they were, but lower. And the question is, how does that impact housing? Well, I think it allows housing to kind of continue doing what it's doing, right? There are always going to be buyers and sellers in a market. And if we see any decrease in interest rates, which I don't think is going to be significant if rates do move lower, I think, again, we have this range that we've been trading in. Yeah, rates could trickle a little bit lower. They could go towards the higher end of that range, which we'll kind of talk about here in a minute. But I think if rates do move lower, it might stimulate some buyer demand, but we're headed into a slower time in the market naturally, right? That fall winter market, typically the market slows down. We've seen a new inventory peak in I think a lot of markets out there, right? A lot of the inventory that we're seeing on the market right now is from buyer demand slowing. We're not seeing a lot of new homes come on the market. We're just seeing less people buy the homes that did come on the market, and those properties are still out there sitting, which is, giving the perception of much higher inventory. It is higher, but it's not rising at the levels that it was. But if rates did go lower, it could put a little bit of steam back in the market, but nothing like we saw back at the beginning of the year. But the more likely case is that rates trade in this range that we've been talking about in this video, somewhere in the mid 4% range to upwards of 6%. Now, I don't know that you're going to hit that 6% number again, personally speaking, but trading in this range keeps things kind of doing what they're doing. Now, understand, as I mentioned a moment ago, you're moving into a slower time of the year, so demand is going to fall off naturally. Affordability, right? It's affected a lot of people out there. So you've got a slowing market overall. But this sideways movement that I'm talking about probably just pushes home prices sideways for many markets out there. Yeah, they might decelerate in some markets, go down a couple of percent in some markets. Maybe in some markets, they actually increase still a couple of percent just based on what's happening to inventory levels there. But there's a really good chance that, as we stay in this current range, home prices just stagnate. They don't really go far in either direction just because sellers have super low rates locked in. They're not going to want to sell these properties, and it's more expensive to go find something else. Investors are going to hang on to property because rents have increased, and if they sell the property, they potentially have to pay taxes unless they invest it into more real estate, and buying more real estate is going to cost them more money. And you still have companies out there like BlackRock. They've just put together a $50 billion fund to buy houses if they decrease in value. So I think the more likely case, rates trade in a range, home prices move sideways, maybe down a little bit, up a little bit, as I mentioned, but I'll continue to keep you updated as things move along. Now, if you're wondering about the video where I talked about how interest rates have peaked and why I believe that, do me a favor and check it out here.